Hi everyone. Today I want to take just a few minutes and talk to you about our main financial statements, kind of what they are, why we have them, and why they are such a vital part of the accounting process. So give me just one second. I'm going to share my screen with you. Get this PowerPoint pulled up. Okay, so you see the slide, just one picture. Decision making should be the word that stand out at you. That is because that is one of the most important outputs of the accounting system would be the financial statements. And financial statements are used primarily for decision making, whether we are inside our company, a manager, a CEO, a vice president, and we are trying to make decisions about, can we hire new people? Can we afford to move and pay rent for a bigger building? Can we afford to open up a location in another state? We're decision making. If we are even people outside the company, for instance, a bank, if we're trying to borrow some money, they're going to look at our financial statements to decide whether or not we are a good person to, or a good business to lend money to. So we see lots of different words on there: ideas, which, how, why, success, goals, analysis, but they all lead to that decision making. Okay, let's look at our completed accounting equation from the earlier part of this chapter. So if you've been following along, doing your homework, paying attention in class, then all these numbers should look familiar. This is the transactions that we went through together and we analyzed, and we know that our accounting equation must always be in balance. Assets equal liabilities plus equity. And we know that there are four things under the equity section: two increases and two decreases. Investments, which are recorded in capital account, increase equity. Revenue, and right now our generic revenue account is titled fees earned. Earning revenue increases equity. And we also know there are two things that decrease equity: the drawing account, when the owner takes money out of the business, and any expenses that we incur. Remember, expenses are the cost of earning revenue. So if you see, not only do we have our equation and have it balanced, 26,450 equals 26,450, but we now also have a balance for every individual account that we used. So if we go down the cash column, we see a balance of 5,900. If we go down the supplies column, we see a balance of 550. Land, 20,000. And we can just keep going all the way across. Well, now that we have recorded all of our transactions, and in this case, these have been for the month of November, we are ready to start on our financial statements. The first financial statement we do is always called the income statement. We always do our three main financial statements in order: income statement, statement of owner's equity, and balance sheet. Then our fourth financial statement, the statement of cash flows, which we're not really focusing on at this point, would come after the balance sheet. So the reason that we do them in this order is because if you look at my little arrow here, the answer from the income statement becomes part of our next financial statement. And the answer from the statement of owner's equity, I'll show you in a minute, becomes part of the balance sheet. So always do them in order. So what is the income statement? The income statement is a summary of our revenues and expenses for any given accounting period. And we said in this example, we were using the month of November. So November only has 30 days. So you see in the heading, for the month ended November 30th, 2023. We're going to list out all of our revenue accounts. In this case, we've only had one so far, fees earned. And then we're going to list out all of our expenses. So where is this stuff coming from? That's right. It's coming from this completed accounting equation. So for instance, fees earned has a balance of $7,500. Wages expense, $2,125. Rent expense, $800. Remember those numbers? Now look over here on my income statement. Fees earned, $7,500. Wages expense, $2,125. Rent expense, $800, etc. So we want to add up all of our expenses to get total expenses, in this case, $4,450. And once we've done that, we subtract expenses from revenue. So 7,500 minus 4,450 gives me 3,050. The answer of our revenues minus expenses is called net income. Net income is our accounting word for profit. So all the revenue we earned minus all the expenses we incurred gives me net income. Now that I have my net income, I'm ready to do my statement of owner's equity, our second financial statement. So our statement of owner's equity is a summary of all the changes in the owner's equity for the accounting period. So once again, for November. Well, earlier in this video, I talked about our 4 things that affect equity. So basically, the statement of owner's equity is summarizing those 2 increases and those 2 decreases. Well, if you think about it, on our income statement, we already summarized revenues and expenses. And we figured out that revenues were greater than expenses by $3,050. So those 2 things I've already summarized, which leaves capital investments and any withdrawals that the owner made. So if you notice, this statement of owner's equity has a beginning capital balance of 0. It is 0 because we are working with a brand new company. This is the first statement of owner's equity we've ever done. And so before this one, when the business first started the 1st of November, there was no equity. We know by looking back at our completed accounting equation that the owner made an investment of $25,000 because we see this $25,000 increase in capital. So I'm going to say Chris Clark capital, and this is the beginning capital. If the accounting period ends on November 30th and it's for a month, then it began on November the 1st. So Chris Clark capital, November the 1st, 2023. I'm going to add any investments, which we just said were $25,000. I'm going to add my net income. Where is that coming from? That's coming from up here on my income statement. So I add my $3,050, and I'm going to subtract withdrawals. Remember, anytime the owner takes money out of the business, it decreases equity. So I'm going to look back on my accounting equation, and I'm going to get the balance of the owner's drawing account, which in this example on the previous slide is $2,000. So I'm going to always say beginning capital plus any investments plus net income minus withdrawals. And once I do the math, that gives me my ending capital. In this case, $26,050. Well, if this is for the month ended November 30th, then ending capital will have the date, November 30th. Okay. So now we have completed our statement of owner's equity. This is just a copy of what was on the bottom of the previous slide. And we're ready to do our balance sheet. So if you look down here at our balance sheet, this should sort of look familiar. Assets, liabilities, equity. Our balance sheet is simply a summary of our accounting equation. We are showing that our accounting equation is equal. And specifically, we're showing the balances of all of our assets, liabilities, and the owner's capital account. Now notice this heading is a little bit different. Instead of saying for the month ended November 30th, excuse me, we're just saying the date, because these are the balances of these accounts as of a particular date, in this case, November 30th. So I'm going to take my assets. So where am I going to get these numbers from? That's right. I'm going to go back here and I'm going to look under my asset heading, and I'm going to have my cash, supplies, land, 5,900, 550, and 20,000. Where are my liabilities going to come from? Right here under liabilities. But now, is this where I'm going to get my capital balance from? No. Okay. Remember, this 26,050, this is now my updated capital balance. So our statement of owner's equity, the answer, if you follow my little arrow, is what you will list on the balance sheet in the owner's equity section. So if you see over here for assets, we were just copying. For liabilities, we were just copying off those transactions. But for owner's equity, we will always only have one account. It will always be the owner's capital account, and the number we use will always be the answer from the statement of owner's equity. So if I add up all my assets, I get 26,450. If I add up liabilities plus equity, I get 26,450. So my accounting equation is still in balance. My balance sheet is in balance. Now, if you will look in Canvas under the Chapter 1 module, you'll see a link for Chapter 1 notes. And these are just some notes that I've typed up for you. And on those notes, I have kind of the template or the formula, whatever you want to call it, for each financial statement. So the income statement is revenues minus expenses. The statement of owner's equity, beginning capital plus investments plus net income minus withdrawals gives you ending capital. And then the balance sheet is assets equal liabilities plus equity. So that's just a brief little summary and tutorial on our 3 main financial statements. Let me know if you have any questions. Thanks for watching. See you soon.